We do think it's overdone, and that's mainly because we're looking around at other markets around the world, the bond markets, currency markets, and we're not seeing the same level of panic. And I think it's because those markets are focused on improving fundamentals, better than expected economic growth, not just in the U.S., but around the world, and a much, much stronger earnings environment than we thought we'd be in 6 months ago. Earnings for 2018, consensus earnings have already been revised up 6.5%. And we're only in early February. So for the market to be tumbling here is a little bit puzzling.
I can't do that for now. Okay, so we'll continue to watch that. You know, the weird thing, though, that we've been talking about is even though this started as a technical problem and we haven't seen the earnings drop down and we haven't seen any sort of a pullback in the economy, these things can build on themselves. And I guess that's what people are wondering now. Is this enough of something, of enough of a pullback that you worry about crowd mentality at this point? Brian?
Yeah, I think that is a concern. I mean, we're seeing obviously some of these rules-based funds, any type of funds that have to do forced selling to rebalance when volatility spikes. There is an ability for this to feed on itself, and I think the Fed also looks at this. They look at asset prices, and there probably is some threshold at which they would be pulling back from potentially a March rate hike. I don't think we're anywhere close to that yet, and while we're not sort of actively in the market adding risk tactically, I think we're certainly having more of a conversation about do we add risk here than do we pull back. So we are constructive. You know, it's hard to be constructive over the next week or two when volatility is this high and just kind of seeing where things are going to go. But I think it's very much the case that over the next 6 months, 1 year, we're very much still buyers, still owners of stocks at these levels.
Ashok, all of this was kind of sparked in part by what we saw with higher Treasury yields, and that made people think maybe the Fed's going to have to raise rates more quickly than anticipated. What does that all mean for bonds at this point? What would you be telling people to do?
Yeah, morning, Becky. So, you know, our view, the bond market is struggling with this idea that the global economy is in a pretty good place, and 2018 is bringing fiscal stimulus in the U.S., fiscal reform in a lot of places, and now probably increased deficit spending in the U.S. And that's just a recipe for an economy, when an economy is at full capacity, for, you know, rising real interest rates. And that's kind of what we've been seeing in the global government bond market so far this year. So our message is, you know, I think the Fed's on track. It's going to do 2 to 3 hikes. That's basically what's priced in the market. But long-term rates are probably going to see a little bit more upside pressure. I mean, 3.25, somewhere in there. We think we'll start to see, you know, a little bit deeper demand come back into the interest rate markets. But credit spreads remain really pretty well behaved. I mean, they're similar to stocks. They had a tightening move back to broadly unchanged on the year. So it's not a story of distress in the credit markets at the moment.
Ashok, you mentioned the global government bond market. In that context, consider where the German 10-year is, about 0.75%. The Japanese 10-year, 0.07%. The likelihood there is that rates stay low for the rest of the decade. In other words, the ECB, the European Central Bank, probably keeps its policy rate negative through mid-2019 and won't go positive till 2020, 2021. Same for the Bank of Japan. So when we speak to the global story, shouldn't we be speaking optimistically about the rate backdrop?
Yeah, I think it's easier to say that about the Bank of Japan and that they'll maintain their, you know, basically 10 basis point target on rates. Europe, I think it's a little bit more of a potentially a complicated story as the year goes on, and, you know, how the ECB will react with their you know, their planned taper. But the other important thing, you know, Tony, as you know, is that with the rising hedging costs, as some of, you know, U.S. yields go up, it's just not as attractive for foreign investors to come into the U.S. markets as it was a year ago or 2 years ago. And so that's, you know, that demand's still there, but it's probably going to be less this year.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.